Yeah, so far this year has been another disappointing year for the global economy. The much anticipated improvement in global growth hasn't materialised. We've seen that weakness in two main areas. So one is at the beginning of the year, the United States economy was weak, partly because of weather effects, partly because of the drag of oil prices on energy investment. But more persistently, emerging market growth is particularly soft, seeing very significant weakness in global trade volumes. We're also seeing Chinese imports relatively weak, which is affecting a number of economies in this region, and Brazil and Russia are both mired in quite deep recessions. Europe is the brightest part of the global economy at the moment, not so much in absolute terms, but in comparison to where it was growing 12, 18 months ago. So you're seeing quite a broad-based recovery across the Eurozone. Spanish GDP is growing very strongly. Italian business indicators have picked up. You're really seeing the fruits of the aggressive monetary policy easing by the ECB, as well as the fact that fiscal drags are much softer. So Greece is the only economy in the Eurozone that's struggling less for idiosyncratic reasons rather than any sort of broader problems at the European level. Yeah, American growth has disappointed in 2015. So there's obviously some temporary weakness at the beginning of the year, but also second quarter growth was only a modest sort of rebound to just over a 2% annualized rate. We're seeing relatively weak productivity growth as well, mainly because investment spending, so the capital spending cycle, is quite soft. Again, this is partly because of the drop down in energy prices, but also the rise in the dollar, as well as some evidence of reduced business dynamism. So the labour market continues to tighten, so this doesn't necessarily prevent the Fed from tightening monetary policy, but it does maybe tell us that the interest rate, the terminal policy rate in the United States may be considerably lower than it was before the crisis. China is a difficult economy to interpret at the moment because its data is relatively opaque. We don't completely trust the growth figures that are being published. However, there is some evidence that growth stabilised or picked up a little bit in the second quarter, but most of that improvement was due to the financial services sector, which has sort of been stimulated by the very rapid rise in the Chinese equity market. So this presents a challenge for the second half of the year because equity markets have sort of subsequently fallen, so that source of growth is unlikely to be there. We're seeing evidence that the manufacturing sector is quite weak, so the government's stimulus through its public investment program is going to have to be quite strong if growth is to hold up. Probably most importantly, growth in China is less friendly for the rest of the world than it was in the past. Because demand for commodities in China has softened quite a lot, so commodity exporters are suffering both on the volume side and because commodity prices have fallen. But even those Asian economies that don't export commodities but export manufactured goods, they're seeing very weak growth at the moment. That's partly because of what's going on in China, but also because a number of those economies have their own leverage problems which they're trying to grapple with. Brazil's suffering from a number of headwinds at the moment. One is the decline in commodity prices. Its economy, whose terms of trade benefited significantly from the rise in commodity prices before the crisis. So that's sort of putting pressure on their external accounts. But second, domestic conditions are very weak. They've had to tighten monetary policy significantly to head off inflation. Fiscal policy has also been tightening, and so this is generating a domestic demand recession as well. On top of this, they're really struggling though to make the size of the fiscal adjustment that's necessary to put public finances on a stronger footing. So recently the government announced that it wasn't going to meet the fiscal targets that it had set for this year or next year, and so the currency sold off for Brazilian government bonds. And there's a genuine risk that the country could suffer a downgrade from investment grade into sub-investment grade over the next 6 to 12 months. So a lot of change is going to be needed in Brazil if this recession is going to come to an end, and if the country is to become less vulnerable to external shocks.